Hi there, welcome to Nepi Invest. Today, update 20 to the performance of Nepi's portfolio. And to be frank with you, it was a quiet week, so no acquisitions, no disposals. I have been thinking about setting one of my companies loose, Treasury Wines, because that is underperforming the market and I want my holdings to outperform the market. That's the whole point of setting up this strategy. And there have been two companies that have come upon my radar in the past week. Those two companies are Mach7 and Next Science. Both companies released an Appendix 4C to the market, and both reports were quite good and quite favorable, and the share price looks like it could be breaking out. So we have two things going for both these companies: share price breaking out and favorable reports. Those two things I really look for buys. Now, the whole point of me setting up this portfolio and using this particular strategy is because I was told incessantly by numerous people that the individual investor cannot beat the market. I still hear it from a lot of fund managers, a lot of professionals, that we as individual amateur investors cannot beat the market, so we should not try. We should just put our money into a market tracking ETF and just not have the worry. And I believe that is complete hogwash. So I set up this strategy and this portfolio in August 2020, and I was just gonna, compare the results, the performance of this portfolio against the benchmark, which was the STW, which tracks the ASX 200. So in this video, I'll be showing you the performance of this portfolio since August 2020 and just comparing it to what has happened in the overall market. You should be able to see that you can beat the market. The individual investor can beat the market quite considerably, because if I can do it, anyone can do it, because I'm not the smartest tool in the box, and I'm pretty sure there's going to be a lot of more smarter people out there who might be thinking maybe they can't beat the market. But if you put the time and effort into doing this, you can definitely beat the market. In fact, this portfolio is double the market returns right now since August 2020. The first thing I usually do in these videos is look to see what's happening in the overall market, and it's important because we are tracking the performance of the portfolio to the market. So I hone in on the XGO, which is the ASX 200, because that's my benchmark, with the STW, which tracks the ASX 200. So I just want to see what's happening in the overall market, see what the sentiment's like. And when you look at the 6-month daily chart, which I'm showing you here, we can see the XGO is trading in this upward sloping channel since November last year. And this is a slight bullish signal, so there is still positive sentiment out there. Now, between about middle of February and March, we were seeing the XGO go towards or head towards the bottom of that channel. And if it fell below the bottom of the channel, that would be a bearish signal, which would mean we potentially are heading into correction territory. But over the past 2 weeks, the overall market has been up a fair bit. I think last week was up about 2 or 3%. This week, we did see the XGO rise just shy of 1%. And in fact, we've gone from the bottom of the channel, and right now we're sitting at the top of the channel. Now, in my opinion, many things can happen over the next few weeks. So in my professional life, I am someone who forecasts the future. It's actually difficult to forecast the future because there's so many possibilities that can happen. So we're trying to hone in on the most likely scenario. And that most likely scenario could be like a 20% chance of happening. So what could happen over the next few weeks with the XJO since we're at the top of that channel? Well, we could head back towards the bottom of the channel quite quickly. I think that's unlikely at this point in time. We could slowly go backwards, maybe over the next 2 or 3 weeks, head towards the bottom of the channel. I think what's most likely now, because we've shown a bit of strength in the past 2 weeks, we're going to go sideways or head up very slowly, sort of mirroring the top of that channel. So I think that's the most likely scenario over the next few weeks, but you never know what sort of news flow over there could trigger a sell-off, or even the opposite. We could see it go higher above the top of this channel. And if the XGO does go above the top of the channel, that will be a very bullish sign, particularly in the short to medium term. Now, in the long term, I am quite bearish. I do believe the markets are quite overvalued, but since the governments and the reserve banks around the world just want the markets and assets to increase in price, that's going to happen for the short to medium term. But in the long term, I believe there will be a significant correction. I just don't know when that's going to happen, but it will eventually happen. On to the performance of Nepi's portfolio, and it's up 5% for the week. So 5 times the market returns. And the main reason for that was the performance of one company in particular, and that was TPC, up $2,438. And that 37% gain seems a little low, but that's what ShareSite gave me. So I got these numbers from ShareSite, and you can use ShareSite for free. Now, I don't get paid by ShareSite to advertise their services, but they are a good website to use if you do have a portfolio and you want to track the performance of that portfolio. Now, you'll see on the left-hand side, which is straight from CommSec, you'll see a lot of green there. And that's the whole point of this strategy, is to let my winners run. Those companies whose share price is increasing, try to keep on them, try to maintain a holding in them as long as possible, and you'll see a dearth of companies in the red. In fact, there are only 3 companies right now in the portfolio that are negative performers, and those 3 companies are Ares Resources. Now, I'm going to ignore Ares Resources from now because I initially bought them at 5.6 cents and they're currently 11 cents, and I transferred that company to my portfolio when they were 12.5 cents. So I'm significantly in profit right now with that company overall, but since I transferred the company into this portfolio, they're down 12%. So ignoring that company for now. Now, looking at the other 2 companies, Treasury Wine and Blackmores, both down just over or just under 2%. I'm not concerned with Blackmores. When I look at the share price action there, still bullish signs, but when I see Treasury Wine, look at their chart, it is looking fairly bearish, and I wouldn't be surprised if I sold out of that company soonish or within the next week. And the whole point of this strategy, let your winners run, cut loose your losers, is the reason why this strategy should be able to beat the market on a consistent basis. So when you look at an ETF, or just think about an ETF, say the STW, it has all the companies in the ASX 200, all those companies whose share price is running, and all those companies whose share price is falling, like AGL or AMP, those share prices are falling. So you maintain a holding of all those companies. In this strategy, we ignore all those bad performing companies and we try to buy those companies whose share price is going higher, who are in an uptrend. And that's why this strategy should be able to beat the market on a consistent basis, because we're buying into companies who are in strength, or their share price is in strength, compared to hanging on to companies whose share price is in weakness. And that's exactly what ETFs do. And that's why this strategy and this portfolio should be beating the market. It's good and well to track the performance of your portfolio over a 1 day or 1 week period, but I believe that's just noise. Anything can happen to set your portfolio apart from the market. So you just have to ignore those 1 day, 1 week performances and focus on longer term. So what I'm going to do in this slide is look at the 1 month performance of Nepi's portfolio, and then in the next slide go to August 2020 and look at the overall performance of the portfolio. So in ShareSite, I've called this portfolio MSP. So the top bit of this, or the summary bit of this, is straight from ShareSite. And over the past month, Nepi's portfolio is up 11.36%. And when you compare that to the benchmark, the STW, that is up 3.75%. So Nepi's portfolio has tripled the market returns over the past month. So that's fairly good over a 1 month period. So I'm very happy with that. And the best performing companies in the portfolio, if you discard the smaller cap companies like TPC, Hammer Metals, and Stonehorse Energy, the best performing companies have been Northern Star up 18%, SG Fleet up 16%, and Clinuvel up 14%. And then the most important slide here is tracking or comparing the market return to Nepi's portfolio return. So since I started Nepi's portfolio in August 2020, the overall market, or the STW, has risen 18%, or 17.99%. We'll call it 18%. So what I want, ideally, is to double the market returns. So hopefully I'm up about 36%. And I'm nearly there, up 35.86%. When you look at capital gains, the STW is up 14.85%, and MSP, or Nepi's portfolio, is up 33%. So I'm doing what I hoped this portfolio would do and double the market returns. at the very least, I want to beat the market by at least 1 or 2%. And again, if I was unable to beat the market, I should just put my money in an ETF, just like all those people said I should do. But at this point in time, I'm on the way to proving that the individual investor can beat the market. If I can do it, everyone else should be able to do it as well. Now, during this period, the best performing company, apart from the smaller cap companies, has been Dusk. So I bought Dusk in late December when they released a very positive trading update to the market. And since then, Dusk has risen 75% and the STW has only risen 7.8%. Next thing I'll do is look at individual companies, the best performing companies and the worst performing companies. And by far, the best performing company for the week was TPC Consolidated. Now, this company is an energy retailer company. They own Cover You, I believe, which is mainly in New South Wales, Victoria. They have expanded into Queensland and South Australia in the past year or so. A lot of tailwinds behind energy retailers, and the complete opposite, a lot of headwinds for energy generators or wholesalers, because energy wholesale prices have gone down over the past few years or so, which benefits companies like TPC. And we can see that in the share price over the past 6 months. It's tripled in price during that time. Now, this company is very liquidly traded, so I would not recommend people buy this company simply because of that reason. I do like liquidity. A lot of people like liquidity. Funds like liquidity, so no fund managers would be buying into this. But one of the reasons why I would say don't buy into this company is a reason I did buy into this company, because illiquidly traded companies can be historically the best performing companies. And simple reason is because what we've seen in the past 2 weeks is a dearth of sellers. And if you don't have any sellers willing to part in their holdings, just like me, anyone who wants to take a position into TPC has to rise or raise the share price. And we've seen that consistently over the past few weeks, where the share price is lower than the first buy bid, simply because there's been no seller. So if you do want to take a position, you have to raise your bid into the market. And that has led to the share price rising quite significantly over the past 2 weeks. And right now, on the last day of trading during the week, it closed at $3.41, which is the all-time high for this company. Now, because the share price has risen quite a bit over the past few weeks, there might be some profit takers trying to come into the market, locking in some profits. I am one of those. I am actually thinking of trimming my position with TPC right now, locking in some of those profits. So just be aware of those few things, the illiquidity of this company, and the fact the share price swings can be quite wild and volatile because it is illiquid. The second best performing company of the portfolio was Hammer Metals, but I'm going to ignore that company now because it rose 20% on the last day of trading, and that was the overall gains in that company during the whole week. And there was no news for the share price to rise 20%, so it's just noise in my opinion. And when it comes to Dusk, the share price rose 7% again on the last day of trading, but that's not noise. They released a trading update to the market, and the last time they released a trading update to the market was December 29, 2020, and that was quite a positive trading update, and that's the reason I bought into this company around $1.98, and the share price has just kept on rising ever since then. There was potential trading channel, sideways trading channel developing, so a consolidation in the share price from late February, early March, which can be very healthy. You want to see consolidation period, and it seemed like it was trading between about $2.80 and $3.25. If the share price fell below $2.80, that would be bearish. But every single time it got below that level, there was buying coming into the market, sending the share price higher. Then they released this trading update to the market, and the share price went up 7%, and the share price finished at the top of that channel. And what happens now over the next few trading days will be important. If we see a little bit of weakness, that would sort of confirm that that is the top of the trading channel, but that could be the new support level, $3.25, because if the share price keeps going higher, that would be very bullish, and $3.25 in the future would be a good buy if the share price retreats back to that new support level. So a few things I'll keep an eye on over the next few trading days with us is to just see what happens with the share price movement. If it goes lower, that would confirm this is the top of the channel, and that would confirm this is resistance. If it goes higher, that would be the new support level. So I hope that all makes sense. If it doesn't make sense, leave a comment in the comment section. I'll try to clarify it. And the final best performing company I want to show you is Amber Technologies. And this is the 6-month chart. If you go back to the start of this period to October 2020, you'll see that one trading day, there was massive volume. And in fact, the share price went from 12 cents to a high of 35 cents. So share price tripled on that day. So what happened to cause the tripling in the share price? Well, they released a trading update, and this should reinforce the importance and the power of trading updates, and it's just as powerful as profit upgrades. So those are the two main announcements I look for every single day when the ASX is open. I'm looking for profit upgrades and trading updates because they can send the share price of a company higher and higher, just like they're doing with Amber Technologies. Now, Amber Technologies' share price is growing or rising very slowly, but that's okay with me because it is rising, and I find these very slow rising share price companies can last a long time. So I wouldn't be surprised to see Amber Technologies' share price in, say, 3 or 4 years to be significantly higher than it is now. On to the worst performing companies for the week, and the first company is Pushpay. But when you look at the chart for Pushpay, nothing of concern here at all. In fact, the uptrend that developed in January is still intact, and that's the main thing. In fact, the share price over the past week has moved towards that uptrend line. So if the share price rebounds over the next week or so, that would confirm this uptrend is still in play. But if the share price falls below the uptrend, that's an automatic sell. So I'll be keeping my eye on the Pushpay share price in the next few trading days, and if it falls below this uptrend, that would be a sell signal for me. Next, I'll be looking at South32, and just like Pushpay, nothing of concern here. So I've kept the moving averages here, and because you can see, in fact, that the 50-day moving average with South32 is a support level. Every time it gets to that moving average, it bounces off it. We've seen it happen about 3 or 4 times, and at the moment it's well above the moving averages. So I'm looking at this chart and I have no concerns at all. The only reason I'd have concern is if we see a bit of sell-off in the next few weeks and the share price falls below about $2.70. If it falls below that $2.70, that would be a sell signal for me. And finally, we come to Email Payments, the third worst performing company in the portfolio. And just like Pushpay and South32, I have nothing to be concerned with when I'm looking at this chart. The whole reason I bought into Email Payments was on the release of the half-year results. We saw the share price gap up on significant volume, and some people would say to you that gaps always fill, so you wouldn't buy into this company. Wait till this gap fills, then you buy in. That's complete hogwash. It's a fallacy. It's a myth. You can see that with the Dusk share price. Go back to that company. That gapped up on the trading update in December, and it hasn't filled yet, and it most likely will never fill. So gaps don't always fill, particularly on these sort of events when there's a positive news announcement and the share price rises or gaps up on significant volume. Share price then went sideways for a while, just consolidating. That's very healthy. And then they released, they made an acquisition on the 7th of April. The market liked that acquisition, and the market to move the share price above a resistance line. So that resistance line became support, and it's remained above that support line since then in the past about 8 or 9 trading days. We've just seen a little bit of weakness in the share price, but nothing to be concerned with because it was on low volume. So again, a very bullish looking chart for Email Payments ever since they gapped up on significant news. And that's all for this video on Update 20 in regards to the performance of NEPI's portfolio. If you have any questions, make sure you leave that question in the comment section or answer any questions as soon as possible. Now, I'm not a financial advisor. In fact, I'm an amateur, and I'm showing you in this video that an amateur like me can beat the market quite easily. And hopefully that fills you with some confidence that you too can beat the market. Don't believe those people who say to you, you cannot beat the market. You can. Just put in some time, put in some effort, and you can significantly beat the market. Now, back to the original point, I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial circumstances. That's all for this video. Have a good day. Bye.